Alrighty, Business 163, Personal Finance. This is our fifth and last video in this module on taxes. And you already know from the title, we're talking about investments and taxes. We're going to give you a few examples. We're going to talk through different types of retirement savings plans and the tax implications thereof. And so hopefully this really helps to broaden your understanding for future planning and future strategy, how to plan for the future, as well as how to plan for the future in such a way that it minimizes your tax obligation both here and in the later. All right, the later in the future. All righty, so you can see from the title slide, this lecture, which probably is going to end up being the longest lecture in this module, is investments and taxes. All right, so let's talk about the primary considerations when we talk about the saving for retirement, investments for retirement, and the tax implications. All right, so the whole idea is to maximize the amount of money you're saving and giving away as little as possible to taxes, especially the money that you're trying to save and grow to provide for your retirement. And so the idea here is that, well, there's some products where I pay the tax now, it's taxable income now, and then after I pay the taxes, I put into some sort of savings account. And the great thing is, the way the tax provisions are written, when I withdraw it later, when I retire, I don't have to pay tax on it then. Those are typically known as Roth products. You may have heard of Roth IRAs, Roth 401ks, those kinds of things. We'll cover some of the specific names for those products. But the whole idea, if you see the term Roth in front of it, is that Roth products are for, you take post or after tax income and you put it in those kinds of accounts. And that means because the tax has already been paid on it, you don't pay for the tax later when you withdraw it. All right. Now, you compare those to traditional IRA products where the money you put into a traditional IRA or traditional 401k, those are pre-tax monies that you put in now. You don't pay taxes on them now, but you're going to pay taxes on them when you withdraw them later, ostensibly when you retire, for instance, right? Now, those are primarily the considerations we talk about. There are also health savings accounts. Those help you out because you don't ever pay taxes on medical expenses with an HSA. Those are pre-tax monies that you put away, you spend on. You don't ever have to pay tax on that income. All right. Now, most retirement saving products are considered above the line deductions. Remember, we talked about that. In other words, they reduce your income, your taxable income, before you calculate your AGI, all right? So they allow you above the line to reduce the AGI before you get to the bottom line there, before you get to your standard deduction decision, right? And so they can be very, very advantageous. Some of the best investment advice you're going to hear is, well, maximize your contribution to your retirement accounts because they reduce above the line income. They're above the line deductions, okay? Now, the big question here is, what do you anticipate your tax bracket will be when you retire? For instance, if you are sort of planning and guessing that when you retire, you will be in a lower tax bracket than you are today. And this holds true for many, many people, right? As they go through their career, they end up earning a lot of money. They get to a position where perhaps they're in executive leadership or they're earning a good paycheck, right? And they presume that when I stop earning that paycheck, when I finally retire, I'm probably going to be in a lower tax bracket. Well, for people like that who anticipate that in the future, when they retire, they will be in a lower tax bracket, it typically makes sense to use traditional retirement savings products. Why? Because you don't pay the tax now when you're in a higher tax bracket. You pay the tax later when you're in a lower tax bracket. So hopefully that makes sense, because that also explains why Roth products can sometimes make sense. Roth products make sense if you anticipate later on in life when you retire, you're going to end up in a higher tax bracket later than you are today. Hey, it probably makes sense to use Roth products. Why? Because Roth retirement products, you use after-tax money now when ostensibly you're in a lower tax bracket. And when you withdraw the money later when you retire, you don't have to pay tax on it when you are in a higher tax bracket. So hopefully that makes sense. You may need to rewind that or just think through that quickly to really understand why it is that depending on what you think your tax bracket is going to be later compared to today, it may point you or suggest to you one or the other of these types of products out there. Okay? Now, you can see here, Roth IRAs allow you to make after-tax contributions best suited for an individual who expects to be in a higher tax bracket when he or she starts taking withdrawals from that savings account and doesn't need the tax deduction now. Versus traditional or pre-tax types of accounts, you can see there, best suited for an individual who expects to be in a lower tax bracket when he or she starts taking withdrawals and does not need the tax deduction now. You can see some examples of those different types of products there. All right. Now, compare the different little names that you hear about these things. You may have heard, hey, I've got a 401k. Hey, my employer has a 403b. Well, those are all refer to articles in the tax code. Remember those 78,000 pages of the tax code, right? So different categories of products in the tax code refer to these numbers. What's a 403b? 403b is typically offered by a nonprofit or government employer, and it's tax deferred and the employer can match contributions. A 401k is typically by a private sector, a for-profit type of employer. It's also tax deferred and contributions can be matched by the employer. An IRA is typically an individual, non-employer based retirement account, and it is for tax deferred contributions. And then you see further on in the list there, a 457B, that's for tax deferred income that can be withdrawn penalty free when you separate from your employer. And quite frankly, there are Roth versions for each one of these products. So remember, Roth versions are after-tax contributions, right? Funded with after-tax dollars. And with Roth versions of a 403b or a 401k or an IRA or a 457b, for each of those examples, Roth versions can be withdrawn tax-free and penalty-free when you separate from your employer. Alrighty, so again, that's a mouthful, and if you have to download this deck and slowly go through those, it will be worth your while to understand the differences between each of these different types of products. Alrighty, so let's keep going. Let's talk about an actual example here so you sort of see how these things all work together. All right, let's talk about a person who earned $55,125 in gross income. All right, and you can see here, filing single, what the potential tax brackets are. 10% up to $98.75, 12% between that and $41.25, and then above $41.25, 22%, and that's sort of where the last dollar of this person's income falls at $55,125. Now, let's consider that they contributed $15,000 to their 401k. Remember, 401k is an above-the-line deduction. And so you deduct $15,000 right off of there, and his AGI ends up to be $40,125. Whoa, look at that. Because of the $15,000 401k contribution, which represents an above-the-line deduction, you've dropped him out of that third tax bracket. $40,125 means the top tax bracket he's at is 12%, he or she, right? So the example of the above-the-line tax deduction above says it'll save 22% of taxes of the $15,000 contributed to the 401k because every dollar contributed would have been taxed at 22%, right? So this person saves $3,300 by making that 401k contribution. You can see the impact here, right? Well, let's keep going, okay? So now let's say this person's AGI is $40,125, okay? And let's say that they can either itemize or take the standard deduction. They decide to take the standard deduction, which in 2021 was $12,550. That means their taxable income is $27,575. Now you can see, right, that if that's the taxable income, you can see how that works out across these two tax brackets, with the top one having a marginal tax rate of 12%, which means this person now has a tax liability of $3,110. We go to the next slide. What if this person has, for some reason, a tax credit of $3,000? Well, remember, the tax credit reduces dollar for dollar tax liability, which means their final tax liability is only $110 because of, first of all, the above the line contribution, then the reduced AGI, then this tax credit, which saved them an enormous amount from their tax liability. So now you can sort of see from this example how all these things sort of fit together. Now, the last slide we want to show you in this deck, and the last thing in this module, is the Kitty Roth IRA. Now remember, Roth IRA means what? You get to contribute after-tax dollars. Well, the Kitty Roth IRA, it represents a triple tax savings for teens who are earning income. If you're a teen, you're a minor, and you are earning income, you've got some sort of a job, earnings grow federally tax-free. You take your after-tax income, right? You can contribute to this Kitty Roth IRA. Qualified withdrawals are tax-free, including if you withdraw for college. The savings will not reduce your need-based aid for college. Most teens make less than the standard deduction, which means they'll not pay any federal income tax on the contributions. So if you've got a minor with employment compensation of $6,000 or less, and you can throw it all into a Kitty Roth IRA, right? It's basically completely federally tax-free. It will always be tax-free. And if you can afford to keep contributing this Roth IRA throughout your life, well, this is one of the best ways to use the compound growth factor of money to most assuredly end up with over $1 million in this Roth IRA by the time this person retires, if they start contributing and faithfully contributes throughout their life, throughout their earning income years. All righty. Man, that's a mouthful, isn't it? This is an awful lot of stuff to consider, but you can sort of see now, just through the examples and through the concepts that we've given you, how all of these various pieces fit together to really advance your retirement planning, your investment strategy, to account for how if you can maximize your tax savings, you can maximize your retirement income when you finally get to the point of withdrawing from these various different investment savings products. Well, man, that's a lot of stuff in this module, isn't it? I hope it hasn't been too confusing or overwhelming for you. I hope it really does begin to crystallize and make some sense as you think about, as part of your personal financial planning and financial literacy, how do I plan for this particular tax system that I'm working with and all of the options that are out there for me in terms of savings and investment to minimize my tax obligation and maximize my retirement savings. Alrighty, I hope that's helpful, and we will see you in the next module.